Learning outcomes. After starting this module, you shall be able to learn about the history of Indian insurance industry, know the life insurance and non-life insurance contract, learn the organization of Indian insurance industry, study the various products and policies of life insurance industry, study the various products and policies of non-life insurance industry. Introduction. Insurance is the mechanism of pooling risk. In a contract of insurance, the insurance company agrees, undertakes for a sum of money, that is premium, to make good the loss suffered by the insured against a particular risk. The risk can be of fire and or any other similar possibility. The company of insurance compensates the insured beneficiaries on the happening of a specified event such as accident or demise. Thus, there are two groups to a contract of insurance: insurer, assurer, underwriter. Insured, assured, beneficiary. The document laying down the terms of the contract is called insurance policy. The property which is insured is the subject matter of insurance. The subject matter of insurance is the interest which the insured has is known as insurable interest. Insurance is a means of protection of economic value of assets. It is a mechanism through which assets are insured against the risk of being destroyed due to any accidental occurrences, so that the owners of the assets can cope up with the economic value of resources. It is also a method of spreading over a large number of persons a possible financial loss too serious to be conveniently borne by an individual. The occurrences which can cause any damage to the assets are known as perils. Insurance reduces the impact of risk on the owner but does not protect the asset or prevent its loss. It can only compensate economic financial losses. As a specialized type of commercial contract, insurance is characterized by some fundamental principles: insurable interest, utmost good faith, indemnity, subrogation and contribution. Next, we will discuss upon insurance industry in India and overview. General nature of insurance industry. The insurance industry has both economic and social purpose and relevance. It promotes individual welfare and provides social security. It reduces risk and helps to raise productivity in the economy. Insurance companies may be organized as either corporations or mutual associations. A corporation is owned by its stockholders, whereas in mutual association, the customers are the owners and management is formally subject to their control. There are various parts of insurance industry: life insurance, health insurance and general insurance. Generally, the insurance companies are financial intermediaries as they collect and invest large amount of premiums through the selling of different types of insurance policies. They safeguard the investors, provide means for pooling, saving and channelize funds to the government and various other sectors. The investments of insurance companies have been largely in government bonds, mortgages, state and local government claims and corporate bonds. The insurance companies are active in the following fields among other: life, health and general, and they have begun to operate the pension and mutual funds also. Next is the history of insurance industry. The story of insurance is probably as old as the story of mankind. Though the concept of insurance is mainly a latest development, especially after the industrial era, past few centuries, yet it can be dated back to almost 6,000 years. Insurance has a history which is deep rooted in India. Insurance in many forms has been mentioned in the writings of Manu, Manusmriti, Yagnavalkya, Dharmashastra and Kautilya, Arthashastra. The fundamental idea of the historical reference to insurance in these ancient Indian texts is the same. That is, accumulation of resources that could be distributed again in times of disasters such as epidemics, fire, floods and famine. The history of insurance can be traced back to the year 1818 when Oriental Life Insurance Company was initiated in Kolkata by Anita Bhavsarto serve the requirements of European community. The pre-independence era in India saw discrimination between the lives of foreigners and Indians, with higher premiums being charged for the latter. At the dawn of the 20th century, many insurance companies were founded. In year 1912, the Provident Fund Act and the Life Insurance Companies Act were brought into force to manage the business of insurance. It was made mandatory by the Life Insurance Companies Act 1912 that the tables of premium rate and companies' periodical valuations should be actuary certified. The existing oldest company of insurance in India is the National Insurance Company, founded in year 1906, and it is still doing business. The Government of India on 19 January in year 1956 issued an ordinance which nationalized the life insurance sector, assimilated 16 insurers that were non-Indian, 154 Indian and also 75 number of provident societies, 245 insurers in India and foreign in total. In India, general insurance was included in the setting up of Triton Insurance Company Limited in 1850 by the British in Calcutta. In 1907, the Indian Mercantile Insurance Limited was established. This was the first company to manage all types of business of general protection. In year 1972, the General Insurance Business Act was passed by the Parliament of India. Resultantly, business of general insurance was nationalized from 1 January 1973. 107 insurers were combined and grouped into 4 companies called National Insurance Company Limited, the New India Assurance Company Limited, the Oriental Insurance Company Limited and the United India Insurance Company Limited. The General Insurance Corporation of India was started as a company in 1971 and it commenced business on 1 January 1973. The LIC was a monopoly till the late years of 90s when the sector of insurance was opened again to the private sector. Before that, the industry consisted of only 2 state insurers, Life Insurance Corporation of India LIC and General Insurers, General Insurance Corporation of India GIC. GIC had 4 companies as its subsidiaries. In December 2000, the General Insurance Corporation of India's subsidiaries were restructured as autonomous companies, and at the like time, GIC was converted into a national reinsurer. Parliament passed a bill which delinked the GIC from its 4 subsidiaries in July of year 2002. United India Insurance Company Limited, National Insurance Company Limited, Oriental Insurance Company Limited and New India Assurance Company Limited. Next is the organization of the insurance services sector. Until 1919, the insurance organization in India comprised 2 state-owned monolithic institutions, namely the Life Insurance Corporation of India and General Insurance Corporation of India and its 4 subsidiaries. In order to improve the quality of insurance services in India, the Malhotra Committee in 1993 had recommended a comprehensive framework of reform in the insurance sector. The insurance industry in India is emerging in response to the follow-up action on the recommendations of the committee. The main aspects of the framework are Insurance Act of year 1938, Insurance Regulatory and Development Authority IRDA Act 1999, regulations framed by IRDA. Next is the classification of insurance industry. Insurance industry in India on the basis of subject matter of insurance can be classified as life insurance and non-life general insurance. Under the life insurance, a specified amount becomes payable on the death of the insured or upon the expiry of a specified period of time, whichever is earlier. Whereas non-life insurance covers losses caused by fire, accident and marine and so on. The structure of insurance in India is shown in the flowchart. Now we will discuss about life insurance. Life insurance contract. Life insurance is a contract that pledges, promises payment to the person who has been assured or to his nominee of an amount on the insured event taking place. The contract is viable for the insured amounts payment during the maturity date or particular dates at regular intervals or unfortunate demise if it occurs earlier. Among further things, the contract advances for the premiums payment periodically by the holder of the policy to the corporation. Life insurance is accepted generally as an institution that eliminates risk by substituting certainty in place of uncertainty and comes to the regular help of the family in the sad event of death, demise of the breadwinner. Life insurance is civilization's partial solutions to the problem caused by death. Life insurance is concerned with two dangers that come in the life of an individual. First, that a premature death leaves a dependent family to look after itself. Second, living till an old age and not having any distinct means of help aid. Life insurance encourages thrift. It allows savings in long term since payments can be made without any efforts because of the facility of easy installment constructed in the scheme. Premium payment for insurance is either in a month, quarter, half year or year. Next is life insurance products and services. Life insurance products come in a number of offerings which cater to the needs of investment and objectives of various types of investors. Following is the list of broad categories of life insurance product. First is a term insurance policy. The basic premise of a term insurance policy is to secure the immediate needs of nominees in the case of sudden demise of the holder of the policy. The holders of policy does not get any financial benefit when policy term ends except for benefits of tax that they can choose to use throughout the policy's term. In the event of demise of the holder of the policy, the assured sum is paid to his or her beneficiaries. Term insurance policies are cheaper relatively to acquire as compared to other products of insurance. Next is whole life insurance policy. Whole life insurance policy is one which guarantees a death benefit cover throughout the life. The assured sum is paid whenever death of the assured occurs. Premiums have to be paid throughout the life of the assured or for a shorter period. Next, endowment insurance policy. In the pure endowment insurance is a plan in which the benefit is payable to the assured only on survival after the specified term. Endowment policies which combine the features of pure endowment and term insurance pay the assured sum either on the death of the assured or after a fixed term. In other words, claims under an endowment policy may arise either by death or maturity. Next is money back policies. Money back policies are an expansion of endowment plans in which the holder of the policy receives a set amount at particular intervals throughout the time period of the policy. In the case of the unfortunate demise of the holder of the policy, the full assured sum is paid to the beneficiaries. The terms again can vary slightly from one insurance company to other. Next is unit linked investment policies. Unit linked insurance policies come under the category of insurance cum investment where one gets the benefits of both investment and insurance. While a section of the monthly premium payout goes towards the cover of the insurance and the left money is invested in different types of funds. These funds invest in debt and equity instruments. ULIP plans are more or less similar in comparison to mutual funds except for the difference that ULIPs offer the additional benefit of insurance. Next is pension policies. Pension policies let individuals determine a fixed stream of income post-retirement. This is an investment scheme of retirement planning where the assured sum or the monthly payout after retirement depends entirely on the invested capital, the investment time period, and the age at which one wants to retire. There are also pension plans of many types that serve various investment needs. Now, it is accepted as insurance product and being controlled by IRDA, that is Insurance Regulatory and Development Authority. Next is life insurance companies. Apart from Life Insurance Corporation, a life insurer in public sector, there are other 23 life insurers in private sector. Most of them joint ventures between Indian groups and global insurance giants. These are Life Insurer in Public Sector, Life Insurance Corporation of India. Next is Life Insurers in Private Sector. Now next is non-life insurance. Non-life insurance contract. Insurance contracts that do not come under the domain of life insurance are called general insurance. General insurance is essentially an insurance policy that protects you against losses and damages other than those covered by life insurance. The different forms of general insurance are fire, marine, motor accident, health, medical, and other miscellaneous non-life insurance. Next is non-life insurance products and services. Non-life insurance general insurance services can be covered into following 5 categories. First, fire insurance. Second, marine insurance. Third, accident motor insurance. Fourth, health medical insurance. Fifth, liability insurance. Fire insurance. Fire insurance is designed to provide for financial loss to property due to fire and other related hazards such as fire, explosion, aircraft damage, riots, strikes, militias and terrorism damage, impact damage, lighting, storm, cyclone, flood, landslide, etc. Property that can be covered under life insurance policy are building, machinery, stock, equipment, electrical installations, goods in open or in godowns, dwellings and other contents, furniture, fixtures, fittings and pipelines located inside or outside buildings, dwellings, compounds. Special policies under life insurance are consequential loss policies cover the loss of profit due to damage to property by fire. Replacement reinstatement value policy is a policy in which it is possible to recover the cost of replacing the damaged property by new property of same kind. Floated policy covers stock lying at different locations, warehouses, godowns, factories. Next is marine insurance. Marine insurance has 2 broad components. Hull insurance, which is concerned with the insurance of the carrier of the goods and is purchased by the owner of the vehicles. Second, cargo insurance provides cover for losses, damages that could occur to goods in transit on sea, rail, road and air. The legal framework for carrying out marine insurance is provided by Marine Insurance Act 1963. The Marine Insurance Act deals with the details of the contents of the marine insurance policy. Next is motor accident insurance. The Motor Vehicles Act requires compulsory insurance to take care of those who may get injured in an accident. The insurance of damage to the vehicle is not mandatory. The liabilities that are to be covered are any liability arising in respect of death, injury to any person including the owner, any liability arising in respect of damage to any property of a third party, any liability arising in respect of death injury of any passenger of a public service vehicle. For the purpose of insurance, motor vehicles are classified into three categories: A. Private cars, B. Motorcycles, scooters, and C. Commercial vehicles, both goods and passenger carrying. Two types of motor insurance policies are available for all types of vehicle. First, third party act liability policy indemnifies the insured against all liabilities caused by injury to any person. Second, the comprehensive own damage losses and act policy covers an entire range of risk, namely fire, explosion, burglary, theft, earthquake, flood, storm, terrorist activity, riot and strike, landslide, etc. Next is health medical insurance. Health insurance covers mainly two types of benefits. First, reimbursement of medical expenses related to specific diseases, and second, hospitalization or domiciliary hospitalization. Some of the policies available under health medical insurance are as following: individual mediclaim policy, group mediclaim policy, Bhavishya Arog policy, Jan Arogya Bima policy, cancer insurance cover, overseas medical. Next is liability insurance. The Public Liability Insurance Act 1991 states the scope of liability insurance in India. Liability insurance concerns itself with the workplace and issues arising out of working conditions, death, accident at work, unforeseen incidents while in employment. Next is types of liabilities. Insurance is available across several types of liabilities. These are known as indemnity policies. Employee liabilities, employees state insurance liability, non-industrial risk, professional liabilities and product liabilities. Next is non-life insurance companies. Apart from General Insurance Corporation of India, which is now Reinsurance Company, and its erstwhile 4 subsidiaries, there are 22 other private sector non-life insurers, most of them joint ventures between global insurance giants and Indian groups. These are following: Reinsurance Company, General Insurance Corporation of India. In the public sector, we have the Oriental Insurance Company Limited, United India Insurance Company Limited, the New India Assurance Company Limited, National Insurance Company Limited. In the private sector, we have all the companies stated as in the module. Summary. In a contract of insurance, the insurance company, insurer, agrees, undertakes in consideration of premium a sum of money to make good the loss which the insured suffers against a certain risk. Insurance is characterized by some fundamental principles: insurable interest, utmost good faith, indemnity, subrogation and contribution. Insurance industry in India on the basis of subject matter of insurance can be classified as life insurance and non-life general insurance. Under the life insurance, a certain amount becomes payable on the insured's death or upon the expiry of a certain period of time, whichever of them is earlier. Non-life insurance covers losses caused by fire, motor, accident, marine and so on. On 19 January in year 1956, the sector of life insurance was nationalized and Life Insurance Corporation was established by absorbing 154 Indian, 16 non-Indian insurers and also 75 provident societies. The General Insurance Corporation of India came into existence as a company in 1971 and it started business on 1 January in year 1973. General insurance business was nationalized with effect from 1st January 1973. 107 insurers combined and formed into groups of 4 companies, namely the National Insurance Company Limited, New India Assurance Company Limited, the United India Insurance Company Limited and the Oriental Insurance Company Limited, and these became subsidiaries of GIC. In December 2000, the General Insurance Corporation of India subsidiary were restructured as independent companies, and at the like time GIC was made a national reinsurer. The main aspects of the framework are Insurance Act 1938, Insurance Regulatory and Development Authority IRDA Act 1999, regulations framed by IRDA. Life insurance is a contract that promises payment to the assured person or to the insured nominees thereof of an amount on the taking place of the insured event. The contract is valid of the insured amount for payment during the maturity date or certain dates at unfortunate death or periodic intervals if it occurs earlier. Term insurance policy, whole life insurance policy, endowment insurance policy, money back policies, ULIP, pension policies are the products of life insurance. There is only one life insurer in public sector named as LIC and 23 life insurers in private sector India. Insurance contracts which are outside scope of life insurance are known as general insurance. Non-life insurance, general insurance services can be covered into following 5 categories: fire insurance, marine insurance, accident, motor insurance, liability insurance and health medical insurance. There are 4 erstwhile subsidiaries of GIC working as public sector company and 22 private sector companies in the area of general insurance. Thank you.